it's a pleasure to have you here today. Before we get started with your main presentation, I was wondering if you could tell everyone a little bit about yourself.
Hi, yes, Karim, thanks for having me. Pleasure to be here. My name is Lucas Outumuro. I'm head of research at IntoTheBlock. We're a crypto analytics and quantitative strategies company. We have analytics for some of our blockchains, including Ethereum, Bitcoin, Polygon, as well as the sidechain, many others. So we cover over 1,000 crypto assets. And we also have a separate division that runs quantitative strategies that generate yield on these blockchains. So me and within IntoTheBlock, I lead the research going into the analytics that we develop, into the protocols that we use for the quantitative strategies, and finally, we create content based on those two areas of research. So that's sort of me. I would like to hear from you guys as well.
It's a pleasure to finally meet someone from that other really interesting side of the crypto space. I really find on-chain analysis as pretty much like one of the most revolutionary aspects of blockchain and crypto. The transparency and openness of data that you can acquire from pretty much any settlement or any base layer blockchain that acts as a settlement, that is just something that was truly missing in our existing world. So it's a real honor to get to meet someone from that other side. My name is Karim. I've been working as a research associate at the company for a couple of months now. I used to work at the University of Cambridge Center for Alternative Finance. So we were working on the third global crypto asset benchmarking study, if you've ever came across it before. So that was really my first thorough introduction to just how the global crypto space operates. And I'm doing my master's on blockchain and digital currency. So I've completely gotten lost in this rabbit hole, and I don't think I'm ever coming back.
Very hard to come back once you're in it, yeah.
It's just impossible. There are no incentives to come back to the traditional world.
Only to migrate in, not out.
Only to other layer one chains.
I will touch on that. We'll touch on that in a bit.
Lucas, how did you get started into research and into the block, and why are you where you are now?
Yeah, so I started researching in the University of British Columbia, my alma mater. And so my last semester, I've always been super interested in technology. So I studied entrepreneurship by background in university. So it's a Bachelor of Commerce, but I always took like economics courses. And like when I found out what was like the world's colliding, and so I talked to one of the professors wanting to get involved, blockchain research arm within the University of British Columbia. And I worked there part-time for about a semester. And then as a bear market hit, that was 2017, bear market hit, I tried to get a full-time job, but it was difficult. So I got involved first with Hedera Hashgraph as an ambassador, mostly just to get to connect with people and learn more technical stuff, which helped me. And then in 2019, I joined IntoTheBlock. I was employee number about 23, 24. And I started initially as an analyst, senior analyst, but as the company grew and we expanded, I sort of naturally became the lead for it. And it's exciting, of course, and very quick-paced, as you might imagine.
Definitely. For people looking to get into research, you've come a long way, I think, really fast. Would you have any advice for people looking to join IntoTheBlock or get into similar companies or get into analytics as well?
Yeah, I think my advice is to drive, to work in what drives you the most within this space. So for me, it didn't feel like working at times, but we would do like a lot of research on interesting areas. And so be curious, I guess. That's might be more natural to some people than others. I have like a deep passion in the space, just get the most out of it.
That sounds like very solid advice. Karim, did you have any questions you want to ask?
Just curious, what was your aha moment that really got you to believe in the fact that you need to find a job within the space?
Yeah, it's a good question.
Sorry.
So one, I'm originally from Venezuela, and as you guys might be aware, the country's in a very rough situation with hyperinflation and a government that has expropriated a lot of private. So that brought me an inherent distrust of large, like, concentration of power. And when I realized that blockchain distributed trust amongst participants of the network, this is like revolutionary and can distribute power amongst people and create incentives towards, like, as utopian as it sounds, but okay, this is where I'm going. And yeah, once I got full time, like, very hard to switch over to something else.
Very
I
nice.
mean, it doesn't get more personal and to be driven by, I think, by a technology or by a concept than what you've just explained. It truly changes
Yeah,
everything that we have been accustomed to.
yeah, and unsurprisingly, in IntoTheBlock, we're like 70% Argentinians. Biggest inflations and political issues throughout the past centuries. So I'm not surprised that's the case, and you often see people from those two nationalities representing within Latin America.
Nice.
A point that I would love to get into later on when it's more appropriate is, have you geographically like visualized the rate of adoption in Latin American countries?
Yeah, it's tough to do that, honestly. Like, through blockchain data, you can tell by time and gauge that, but it's not perfect. But within Latin America, you get like indices from web traffic towards the most popular sites, and I believe Argentina, Venezuela, and also Brazil, because it's a very big country. Per capita, I think it's the two, Argentina and Venezuela. Talking about Polygon, given the launch of the Polygon Ecosystem Token, specifically data that we extract from the blockchain to give a deeper insight into the growth and traction or adoption of. And so it'll be an overview of Polygon, on-chain analytics, and the growth of its ecosystem. So let's get started. So Polygon is a complex system, so don't be scared if you jump right into this. But their idea is to become blockchains within the Ethereum ecosystem. Is that they'll be connecting the Ethereum mainnet to a series of scalability solutions, which each have their own set of trade-offs, from being quicker to more secure to being permissioned in the case of the security chains and enterprise chains, amongst other things. And this is like their main solution longer term. And they recently merged with ℂ𝕠𝕧𝕖𝕕, which was quite interesting and a first for the blockchain space. Being optimistic rollups, which were one of the most sought scalability solutions, and enterprise permission. So this approach is to how Polkadot or Cosmos is structured, where each sub-network within the network have their own set of trade-offs and the different applications within each other as well. One part of the Polygon ecosystem, and the other is what's live right now, and it's the most used, and what Polygon more knows, which is their separate proof-of-stake sidechain to Ethereum. What do I mean by sidechain? Polygon, well, in Polygon's case, it's not really a layer 2. It's what's known as a sidechain, meaning that the transactions, even though it's EVM compatible, they're validated by a separate system of nodes. They rely on their own validators, which is still quite decentralized as well, with a few hundred or thousand validators last time I checked. But it's not fully like a layer 2, but it's also not fully another separate layer 1. So it's an in-between, and it's proven very effective, ameliorating the very high gas costs that Ethereum was having. Easy to deploy for developers. So they've been able to benefit very successfully throughout past 2021 with their highly scalable sidechain, which is cheaper, faster, and also offers higher transactions per second. Okay, I'll be diving into some key metrics just to monitor how vast the growth has been for Polygon, especially in 2021. So we've seen, first, for daily active addresses, what this essentially means, it means it's an address that's making a transaction on an outgoing transaction specifically. So it doesn't include addresses that are receiving tokens, for instance, without them knowing. And so this is a metric that we call daily active addresses, as opposed to daily active users, which is the tech lingo, traditional tech, because essentially it's very hard to tell how many addresses a user has. Daily active addresses is the closest proxy. This is that we have to monitor adoption within a blockchain ecosystem. And so we've seen massive growth of 525x. So that means it's grown to be 525 times greater than it was in January 2021. which I believe has been sort of sitting range bound between 250,000 and 350,000. So recently, this past September and October, Polygon surpassed it and it's above it throughout the past few weeks, which is quite impressive. And as I mentioned, there's a lot of benefits to deploying and using Polygon as opposed to Ethereum and other networks. One of them being, of course, lower fees. So this metric is more self-explanatory. And we can see here that even though average transaction fees has increased, by the way, makes sense since the fees are paid in MATIC, the Polygon native token. The price has appreciated of the token. The average fees have increased along with it, but still they're not prohibitive for usage of the blockchain since they've remained highest under $0.015, so less than 2 cents at the highest. Of course, more complex transactions such as staking or providing liquidity tend to go slightly above this, but in general, it remains quite cheap for users to take advantage of, and 99.9% cheaper high gas fees. So that's led to a lot of activity into this ecosystem, as we'll get into briefly. The other side of the equation is that although there's higher usage per user, there's demand. So we can track the aggregate amount spent in Polygon transactions, which we refer to as total fees. And we can see that it's reached at its highest around $100,000 per day, when Ethereum processes, I believe, up to 80 million of fees. And this is good and bad. So as I mentioned, it's good for Polygon because it shows that it's a solution for its users. Also demonstrate that the aggregate demand is lower than it's for Ethereum, which, by the way, it's the case with any other blockchain. Even Bitcoin has less total fees than Ethereum by a significant margin. Let's dive into the ecosystem, which of course is, I guess, why most of you guys came here, given the release of the ecosystem token really speeding up in 2021. As I mentioned, we've seen hundreds of applications being deployed into Polygon, DeFi alone, as using data from DeFi Lamb, and it's out as of last week. So maybe by this week, we've already seen a couple more. I wouldn't be surprised. And this growth has really been kickstarted by the first of its kind liquidity mining program, not run by an application itself, but rather by the underlying, has been quite revolutionary, and it's been copycatted recently by some other blockchains, also to a degree of success. The Polygon team has been smart and is trying to get more traction in use cases outside of DeFi with their 100 million fund for gaming. And as I mentioned, the growth has been quite insane. So parabolic, as people like to call it in crypto. 14,000x increase year to date in terms of total value locked. For those uninitiated, total value locked essentially means the liquidity deposited into these DeFi platforms. And it's become, even though it has its own downsides that we won't get into right now, it's become the main metric to gauge adoption in DeFi, since users need to deposit capital or liquidity into most protocols to be able to use them. Total value locked here in Polygon's case grow from just under 100 million, just 10 billion. And this growth, I believe it was late April here when they launched the incentive program, which was initially 3 months for phase 1 and then another 3 months for the second phase, which we're in right now. But during the first phase, it was very successful. It led to the deployment of more applications into Polygon, like Aave, Curve, and users into Polygon, essentially bringing that future demand ahead, bringing users down along with it by giving users MATIC token for depositing into these applications. 60% down since the highest. Since the phase 1 of the rewards finished, it remains 40x higher than it was before the program. So I would argue it was quite successful in bringing users to try Polygon and get familiarized with it. And so Aave is a lending platform, one of the biggest in all of crypto for decentralized lending platforms, that is. And they're the #1 application on Polygon. And of course, we see a very similar pattern. They had barely any value locked. So they deployed initially in February, but they got a little traction at first. And then once the liquidity incentives kicked in April, we saw a massive growth from under 100 million to nearly 4 billion, and then stay around 2 billion, which of course is a lot higher than what it started at. And I should mention, even as Aave on Polygon started growing throughout April, it interestingly didn't cannibalize the growth in Aave's deployment on mainnet. So we saw continued growth in the total value locked in both Polygon and Ethereum, which I believe is a sign that, one, we're still early. It's not going to be like, oh, everything's migrating to Polygon, everything's migrating to Solana, whatever. No, it seems to come, and we're starting to see that first with the Polygon mining and now with other copying them. And as well, another of the biggest players, and this one is native to the Polygon ecosystem, is known as Quick Centralized Exchange. And I noticed it's one of the largest allocations in the Polygon Ecosystem Token. They got the first mover advantage. They were the first decentralized exchange to gain a significant amount of volume within Polygon ecosystem. And they're a fork of Uniswap v2, meaning a copied version of Uniswap v2, which then added some different intricacies into the equation. And they saw in 2021, 2000x increase in value locked quicker. So 3,500 times what it was at the beginning of the year. All around, great signs of growth, even though it's slowed down past few months. We saw a lot of liquidity providers and traders benefit from this application. And finally, applications outside of DeFi. There's, of course, OpenSea, which is as many as the largest NFT platform marketplace. Started already with quite a significant amount of volume from the get-go, which was impressive. I think there was a demand for NFTs outside of Ethereum, where you pay like $50 just to buy an NFT and gas fees. And so the demand started relatively high, about $200,000 per day. And without any tips, it's managed to around 2 million per day and then dropped towards 1 million per day. So it still remains 101% of the trading volume in Ethereum, but nevertheless, we're seeing organic growth in it, and I wouldn't be surprised if it continues to grow as more retail users oscillate towards the lower fees provided by Polygon. Polygon's sidechain has established as a cheaper, more scalable alternative to Ethereum in a way, and you can easily bridge between them. They're also developing the broader view for an interoperability between multiple sidechains, which is very exciting and can bring a lot of potential for Polygon long term. Just this past 2021, it's already developed one of the most robust ecosystems with growth in the thousands of percent or thousands X, which is even crazier throughout just 2021. Liquidity mining program where they rewarded users with MATIC really, I think, changed the game for other alternative chains that want to generate traction, as it proved quite effective at bringing users and liquidity, and even in a sustained way. So you didn't see it crash back to zero where it was before the incentive, to, I would say, more sustainable growth for the Polygon ecosystem, even though it got quite wild at first. It seems to have been the right decision, in my opinion. And we see, aside of DeFi, we see growing potential for the Polygon ecosystem to continue to develop within gaming and NFTs marketplace in general. So that's it. Now, Karim and Kriyan, I'm open for your questions. I know you guys might have a lot.
Too many questions, not enough time. So the first thing that I was really interested in, I think everyone is quite aware of. Regarding the daily active addresses, so we've seen that the total value locked has been decreasing quite, not aggressively, but it has been decreasing over the past 2 or 3 months. What do you think is happening when we're seeing a decline in the total value locked, but at the same time we're seeing an explosion in
Yeah.
the number of daily addresses?
Yeah, great question. I think it's moving away from institutional volume and liquidity being provided. So there was this demand for the yields that came from the face of Polygon.
Yeah.
Like ℂ𝕠𝕧𝕖𝕕 ourselves, we've monitored yield farming within the Polygon ecosystem during that phase one. But as the rewards dropped significantly, like somewhat decent yields, but within 8 to 10% range. And especially as there's more offerings for higher yields outside of Polygon, a lot of the institutional liquidity migrated, but the retail users continue to use it. And yeah, you saw that in the daily active addresses chart, which suggests to me that there's more organic adoption fostering in the Polygon ecosystem.
So yeah, it's not just, as you just explained, not just institutional interest, but people who have 1/100th of the capital that might be allocated through institutions. Like this is what is prevalent on the MATIC ecosystem.
Correct. It's a lot more beneficial for your average user. So we're seeing a lot of, from what I've heard, at least, users that haven't even used Ethereum start with Polygon since it's a lot more affordable.
Kick it off with Polygon immediately. Yeah, it makes sense. Something else related to that point. So if you would to distinguish between DeFi and NFTs, like NFT gaming or just all sort of different sectors under NFTs, does total value locked make sense to NFTs?
No, I wouldn't say that's the main metric for NFTs. Actually wasn't considered in it because volume for NFTs, it's not like you have capital locked in or stored within smart contracts. It's more like the NFTs themselves are not valued until they're acquired. So it's not like you would have to measure total value locked in NFTs, and since they're non-fungible, you can't aggregate that. Different than has a different value. So the best metric to track that is volume. And in games, games have their own marketplaces like Axie Infinity. I think the most popular game in Polygon ecosystem is Set Run, which is like a horse game. I haven't played it myself, but I heard it's interesting. And so there's digital horses, of course. And so I think they might have had their own marketplace where they generate volume and they have revenues from selling those horses. Another key metric that we've looked at ℂ𝕠𝕧𝕖𝕕. Not for this game in particular, but in general, more for Axie.
Okay, so when we look back at total value locked, I'm sure that you've seen the discrepancy between how DeFi Llama tracks total value locked as opposed to DeFi Pulse. Just for people who are not aware of why there is a discrepancy, would you like to explain just based on your understanding of how it gets queried in a way?
So there's two main platforms for total value locked data, just as you mentioned, DeFi Llama and DeFi Pulse. The main difference, to my knowledge, is just the amount of protocols that are considered by DeFi Llama. So if you compare Aave, which I have in Polygon on DeFi Llama and on DeFi Pulse, they have roughly the same numbers, but DeFi Llama tends to be quicker at adding more protocols and more blockchains. So I believe DeFi Pulse only covers Ethereum and Polygon, which they added recently, and DeFi Llama covers like 12 different blockchains and side chains like Polygon.
That's true.
Difference, but in general, both the amount of liquidity in the smart contracts belonging to these DeFi protocols.
So something to build up or as a follow-up on that point, when you are providing liquidity, like just in terms of liquidity mining, you are depositing your funds and then you're getting like a receipt token that you can further use in other forms or in other DeFi protocols. Is there a way to distinguish between not counting, because if you think about it, it's like a double calculation. If you're counting both as the same value that is being locked, even though they should not be added up. From your understanding of how data is queried on the blockchain, is that something that can be separated?
I haven't done the analysis myself right now, but there's definitely a way to separate that. From my intuition, really, I've seen some data, but not the full amount of it. Most people that actually deposit into a protocol just do it like a one-way, like not a loop. They don't do more advanced things on top of it. But yeah, you're correct in that there are some applications where you can deposit your liquidity pool tokens and then maybe use it as collateral for a loan. In the case of like Maker, there's also this new protocol 𝕂𝕕, which is known for that. So that's a Lego on top of a Lego, as we call within DeFi.
Money.
Yeah. But from my intuition, at least, most people stick with just the first use case and rather than building towers on top of it.
Okay.
Would be
So
very
it's-
interesting to look into more in detail, though.
Yeah, this is actually one of the things that we have been discussing at like as a research team, because we, as much as I think you would agree with this, total value locked has been a great metric. It was awesome for as an introductory evaluating methodology, but then it's very limited. It's exactly like using just price until now. Like it doesn't give you the full story really.
Yes, in a way. And I agree for each DeFi protocol. Like if you guys have the time, listeners, look into what's the most relevant metric for each. So for DEXs, it tends to be volume. For Aave, for lending protocols, I would argue that it's loans outstanding. That's a better metric than total value locked, since at the end of the day, you need lending, people borrowing on top of that capital being deposited. And it's a shame that total value locked actually deducts that from the amount. So if you see, and I'm getting like into the details a bit too much in depth, so let me know if I should go more general. But yeah, if you see like the market size of on Polygon and any of the other chains that they're in, it's about a significantly amount higher than the total value locked, because the total liquidity in the smart contracts is reduced by the loan amounts, since it goes to the user addresses.
Oh, that's very interesting. I never connected those two dots.
Yeah, in a way, it's like unfair for lending protocols because they get a deduction on the liquidity supplied. The total liquidity supplied is higher, but there's a certain amount that gets borrowed by users that it gets deducted.
See, that's my aha moment of the day.
Yeah, I think most people don't realize it, so I often say it, even though it's like very deep in the weeds of crypto.
Creon, did you have any questions regarding the first or two slides that we came across?
Oh, well, for me, like you mentioned, total value locked is not an accurate metric anymore. And I was just curious, you guys are the researchers, I'm just the average crypto user right here. If we're not using total value locked, then what would be a possible like theoretical metric that we could use or methodology to value things?
Yeah, it's a good question. And that's the thing. The good thing about the value locked is that it applies to the vast majority of DeFi protocols. But as I mentioned, also, it doesn't really apply to NFTs. But within DeFi, it's like a good metric to gauge the capital trusted by investors to DeFi, but it varies. So I would compare decentralized exchanges by volume, NFT marketplaces also by volume, games maybe by the amount of active addresses. It might be a better metric. But yeah, it's less generalizable, these metrics. So I think that's also a reason that it's been so popular, is that you can generalize it and compare across the whole DeFi sector, even though it might not be as applicable for each application.
Yeah, it was a first good step to just, because it was pretty much applicable, because even when DeFi started, we had 5 or like even 4 sub niches of DeFi. So you didn't really have to go into the like absolute complexity of what happens now, like an algorithmic stable coin that's worth $1,000. Like how did we reach that suddenly? Like
yeah, it moves very quickly for sure, and the metrics don't catch up, and it's a process that takes time and a lot of user education for us to get into better metrics, I guess.
so something else regarding how what do you need as a company that wants to provide its own on-chain analysis? Do you guys need to run like a full blockchain node for each of those blockchains that you target?
In our case, we run the nodes for, I believe, 15 different blockchains, sidechain. Polygon, we've just gotten into more recently. But yeah, we run the nodes, which essentially means we extract terabytes of data on a daily basis from transactions, addresses, fees, multiple other indicators for each. In some cases, we even run more advanced algorithms to classify the types of addresses that are within the network. So we can classify exchanges, centralized or decentralized. We can classify miners for blockchains that have proof of work and monitor their activity, since they're, of course, key pillars for the blockchain ecosystem, both miners and exchanges. So that gets even more advanced, but just digesting all that raw data from the nodes, we take a lot of effort digesting the data and turning it into actionable indicators.
I think that takes actually the core of your concentration and effort.
I joined when the product was in beta. And before that, the team had taken about 9 months or so just setting the core infrastructure. And from then, we were able to move a lot quicker.
Modify your strategies, but you had the base there to just keep working on.
And now with a lot of the upcoming blockchains or sidechains being EVM compatible, there's some additional effort, but there's less than starting from scratch.
Literally my next question. So with the rest of the other layer 1 blockchains that are EVM compatible, from your own experience, or at least if you haven't been included in it, if you know about it, Ethereum is an accounts-based blockchain, so it works quite similar to how a bank has the debit and the credit components. With Bitcoin, it's all about the unspent transaction output. Now, with the emergence of all of those new blockchains, is it still an account base? Is it shifting to a new model that we are not used to yet?
I believe most smart contract platforms are account based. I think Cardano is the only exception that I'm aware of that's UTXO based, even though they still don't have applications running, but that's a separate topic. Most of the layer 1s that are getting adoption are account based. They have some like intricacies that make it different, from Avalanche to Polygon to Phantom to Ethereum. But overall, they try to make it relatively similar, or as similar as possible, such that they don't create a barrier to entry for developers to deploy their dApps on their ecosystems.
Yeah, it's easier to work around.
For sure. If not, like bridging from one blockchain to another becomes a deeper problem. And Solana has been able to move past it with a separate infrastructure. But I think that's like a standalone case, whether other blockchains really benefited from having the existing Ethereum ecosystem deploy on their blockchains.
Like the compatibility of the architecture itself made it easier, but
for sure.
Since you're reading my mind, that was actually my next question. Solana.
2 in a row.
What has been your experience querying data of Solana, if you guys have started dabbling your toes into it?
No, I'll be honest. It's a completely different infrastructure. It's on Rust instead of Solidity, and not EVM compatible. So right now we're still like on the research stages of getting into Solana as a company. Like personally, I've used Solana, Phantom, and some of the main dApps, and it's quick, it's cheap. But yeah, it still has issues. Like it did go down for a full day. So
17.
Yeah, 17 hours. Sorry.
Yeah.
But yeah, it's a very interesting ecosystem as well, and we'll see if they actually do live up to their promise.
They have loads of potential, and they've marketed themselves as not the competitor of any public blockchain, but the competitor of NASDAQ. So they have a lot of targets to fulfill.
For sure.
What else? So we spoke about the daily active addresses. Regarding the average transaction fee, I think this was publicized, I think yesterday or the day before, where Polygon said that they were going to hike the minimum fee to 30x of what it has, based on some kind of a chart that they provided on their Twitter. It's going to be 30 GWEI, GWEI. Is that how you say it actually?
Some people say GigaWei, because Wei is like the original, and it's 1,000 Wei. I just say GWEI, or GUI, Well, honestly, for people are just figuring it. But yeah, I didn't see that they increased it by 30x, to be honest.
They were saying that it's based on the fact that there's a lot of spammy transactions being sent to the blockchain, which, like, if you're thinking about it and going back a couple of steps to how Ethereum started, this was one of the models of how they decided to like dodge or prevent a lot of scams and spammy transactions to go on the blockchain.
Yeah, it's a downside of having too low fees that people can just transact and try to spam the network and clog it when it's really cheap to do so. There's almost no cost in doing so. So makes sense. I'll definitely be tracking the effect on daily active addresses. And also, because to be honest, going from 1 cent to 30 cents, it's not like too much for the average user. I don't know. Maybe for some it is, but 30 cents is still like acceptable in most cases, I would argue. So we'll see if it has significant effect on the key metrics that we covered. But yeah, I'll look into it. I hadn't seen it, to be honest.
So building on what you just said, do you have new metrics, or do you think, are you guys doing a bit of research on new metrics that can be implemented on Polygon, for instance? Because I'm a frequent user actually of your platform, because that's what we usually look at next to Glassnode and all the other on-chain analytical platforms for our newsletter. So I'm just intrigued by your on-chain metrics. Or is there like a new domain that you want to get into?
Like for Polygon, it will be similar metrics that we're working on to what we currently have on Ethereum. But we're definitely looking at adding more. We've had that in our backlog. So for instance, one that we missed and we've been trying to push, and I think we're finally having time this quarter, is like the ownership by address ranges. So the amount of addresses that have 1 BTC, 10 BTC for any asset, and the volume that they hold. That's one that we've had in the backlog for a while that we're finally shipping in this quarter. We're also launching a new NFT analytics site, which will be very cool. It'll be a visual journey where you can essentially see analytics and the pieces themselves at the same time. That it's been in our backlog for a while. I've been researching and working with our design team on that. And I guess that's the next major release that we have, ideally this quarter.
That's awesome. Yeah, because that's actually one of the other things that I've been thinking about. We keep saying we understand that based on the technology, we can track the full history of how a piece from the day it got minted to the day it reaches the 150th secondary sale, but it still required a bit of technical sophistication to track addresses yourself on Etherscan. But I haven't really seen the other on-chain analytical platforms provide something like that.
It's a big area of opportunity for us. To be honest, I wish we had already shipped it because I've been working on it since March. But yeah, it's hopefully exciting, and hopefully the momentum within the NFT space sustains at a high level by then.
I don't know about high level, but it is definitely here to stay. Like this.
Yeah, it has waves, of course, within it. But yeah, it's here to stay. I agree.
All right, guys, I've got to cut you off. Lucas, is there anything you want to plug about IntoTheBlock, your Twitter account, or something that IntoTheBlock's coming out with that listeners should say, hey, we should go to IntoTheBlock and have a look at it, or anything?
Sure. Yeah, play around with our website. That's IntoTheBlock.com. Follow us on Twitter. We provide like insights into a lot of what's going on in the market in our Twitter. And me personally, I also write articles, so you can follow me on Twitter. My username's my name, just at Lucas Outumuro. You might be able to find my name somewhere if you want to copy paste it. And IntoTheBlock as well. It's been awesome to be here. Thanks, Grian, for organizing. Pleasure to meet you.
You guys had some amazing conversation. Very interesting. I'm still going to have to spend hours tomorrow thinking about it so I can understand it.
If you have any other questions, yeah.
I will definitely teach you guys up.
I'm just going to ask one last question.
Sure.
Regarding MEV, how is MEV sort of trackable, like through blockchain explorer? Is it at the end of the day, you have a transaction in the mempool, it gets sandwiched, and then you have another transaction with a higher gas fee that just steals away the value that the original transaction was going to get?
In short, it's very hard to track because it's in a separate overlay mempool, but through flashbots and many of those, flashbots being the biggest, you can get some data to see what are the MEV opportunities. Even in the blockchain itself, you can gauge and like assess, oh, that was probably like a transaction where someone got screwed because they paid the miner, but it's hard to tell, and it's more case by case.
Okay, so it's not really something ready to be integrated, essentially.
Not at IntoTheBlock yet, no. Even though we've looked at it and there's quantitative strategies, we've not gotten like the full picture, which is why we try to capture it in our analytics.
I see. That's something I'll be anticipating and looking forward to if you guys ever work on.
Awesome. Thanks for having me, guys. Wish you guys success with the Polygon Ecosystem Token.
Thank you, Lucas.
Appreciate
We appreciate it. You guys take care.
Okay.
And
Have a good day, everyone.
Bye.
bye-bye.